Ever wondered what happens when the world of cryptocurrency collides with the long arm of government regulation? Specifically, what happens when one of the biggest players in the crypto exchange game, like Kraken, finds itself in the crosshairs of the U.S. Securities and Exchange Commission? That's precisely what we're diving into today. Forget the usual "Hey everyone, welcome back to the channel." We're jumping straight into the heart of a story that has major implications for the future of crypto in the United States and beyond. For those unfamiliar, Kraken isn't some fly-by-night operation. Founded in 2011, it's one of the oldest and most respected cryptocurrency exchanges globally, known for its robust security measures and a wide array of trading options. Think of it as a seasoned veteran in a rapidly evolving digital landscape. Now, enter the SEC. The Securities and Exchange Commission, a U.S. government agency, is tasked with enforcing federal securities laws and regulating the securities industry. Their mission is to protect investors, maintain fair and efficient markets, and facilitate capital formation. Traditionally, their focus has been on stocks, bonds, and other conventional financial instruments. However, the rise of cryptocurrencies has thrown a fascinating curveball into this established order. Are these digital assets securities? Commodities? Something else entirely? This is the multi-billion-dollar question that regulators around the world are grappling with, and the SEC has been increasingly assertive in its stance, arguing that many cryptocurrencies, and the services surrounding them, fall under their jurisdiction. This brings us to the crux of the matter: Kraken and the SEC. In recent times, Kraken has faced significant scrutiny and enforcement actions from the SEC. To truly understand Kraken's response, we need to break down the key areas of contention and how the exchange has reacted. One of the most notable clashes involved Kraken's staking-as-a-service program. Staking, in the crypto world, is akin to earning interest on your cryptocurrency holdings by participating in the network's operation. It's a popular way for investors to generate passive income. However, the SEC took the position that Kraken's staking program constituted the offering of unregistered securities to U.S. investors. Their argument centered on the idea that Kraken was pooling users' crypto and offering a return based on their efforts, thus meeting the definition of an investment contract under the Howey test, a long-standing legal framework used to determine what qualifies as a security. The SEC's action against Kraken culminated in a settlement announced in February 2023. As part of this agreement, Kraken agreed to immediately cease offering or selling securities through its staking services to U.S. clients. They also agreed to pay a $30 million penalty. This settlement sent shockwaves through the crypto industry. It signaled a clear intent from the SEC to regulate crypto staking platforms as securities. Kraken's immediate compliance, while perhaps a pragmatic business decision, also highlighted the significant power and reach of the SEC. However, Kraken's response hasn't been solely one of compliance. While they adhered to the SEC's demands regarding their staking program for U.S. users, they've also voiced their disagreement with the SEC's approach and the lack of clear regulatory guidelines for the crypto industry. Following the settlement, Kraken's co-founder and then CEO, Jesse Powell, publicly expressed his concerns about the SEC's enforcement-first approach. He argued that the lack of clear rules was stifling innovation and creating uncertainty for businesses operating in the crypto space. Powell, known for his outspoken nature, didn't mince words. He highlighted the difficulty for crypto companies to navigate the regulatory landscape when the rules of the game weren't clearly defined. He advocated for a more collaborative approach where regulators work with the industry to establish clear and workable frameworks. Furthermore, Kraken has continued to operate its staking services for non-U.S. clients, indicating their belief that the service itself isn't inherently problematic, but rather the SEC's interpretation under U.S. securities law that led to the enforcement action. This suggests a strategic decision to comply where necessary but to continue offering services where legally permissible. Beyond the staking issue, Kraken has also been proactive in engaging with regulators and policymakers to advocate for clearer and more sensible crypto regulations. They've participated in industry discussions, responded to regulatory proposals, and sought to educate lawmakers about the intricacies of blockchain technology and digital assets. This engagement reflects a broader strategy within the crypto industry to move beyond a purely adversarial relationship with regulators and to actively participate in shaping the future regulatory landscape. Exchanges like Kraken understand that long-term success requires a degree of regulatory clarity and acceptance. Another aspect of Kraken's response involves their commitment to compliance in other areas. They have invested significantly in building robust KYC, Know Your Customer, and AML, anti-money laundering, programs, which are crucial for preventing illicit activities on their platform. This proactive approach to compliance, even before specific SEC mandates in certain areas, demonstrates a willingness to operate within established legal frameworks. Moreover, Kraken has continued to expand its offerings and explore new avenues within the crypto space, albeit with a more cautious eye on the regulatory environment. They've listed new tokens, expanded their trading pairs, and explored potential forays into other crypto-related services, all while presumably factoring in the potential regulatory implications. It's also important to consider the broader context of the SEC's actions against other crypto entities. The case against Kraken is not an isolated incident. The SEC has been actively pursuing enforcement actions against various crypto platforms and projects, alleging the unregistered offering and sale of securities. This broader crackdown suggests a concerted effort by the SEC to assert its authority over the crypto industry and to bring it within the existing securities regulatory framework. Kraken's response, therefore, needs to be viewed in light of this wider regulatory push. Some critics argue that the SEC's enforcement-first approach is stifling innovation and driving crypto businesses overseas. They contend that the lack of clear rules makes it difficult for companies to operate legally in the U.S., leading to a brain drain and hindering the development of the crypto industry domestically. On the other hand, proponents of the SEC's actions argue that investor protection is paramount and that the crypto industry should not be exempt from the same securities laws that govern traditional financial markets. They point to instances of fraud and market manipulation in the crypto space as justification for stricter regulation. Kraken, caught in the middle of this debate, has attempted to strike a balance between complying with regulations and advocating for a more constructive and clear path forward for the industry. Their actions demonstrate a recognition of the SEC's authority while also highlighting the need for a more nuanced and tailored regulatory approach to digital assets. With that said, thanks for watching and until next time.